When people bring up the words stock market, it sounds like a foreign language to most of our society. At one point in time, I was just like you, curious of what's on the other side of financial investing. How much risk is really involved? Can I make a full-time income from it, or will I lose all my money? I decided to make this video to bring some clarity into understanding what investing is and how people can stray away from that scarcity mindset. A lot of my friends and family have been asking me whether or not they should open up an account, and they're kind of indecisive if they should do it with a certain specific brokerage that they're interested in, or a brokerage that I prefer or that I'm familiar with. So I just decided to make this video to kind of give you guys more clarity and more of a mindset towards investing and the principles behind it. So a lot of questions I get is, how much money do you lose in the market? When should I get into the market? When's the best time? What's the approach I should take? What type of account to open up? So overall, about the account types, people think about brokerage accounts as something similar to checkings or savings. It is kind of similar, but it does not work the same at all. I'm going to kind of elaborate on that right now. So basically, when it comes to a brokerage account, you can buy stocks with that. You can purchase individual stocks that you choose. But when a checking account is made, or a savings account, you're not allowed to purchase a stock. So for example, let's say I bought Tesla and I wanted one share of Tesla, and I went to a bank teller and I waited in line to get the bank teller to actually do the investment for me. They're not able to do it on their end because you gotta have a specific account type in order to do that. When's the best time to open up a brokerage account? So literally, like, if you really want to, you should pause this video, look into some brokerages. I'm going to make another video explaining that. But overall, you should really open up a brokerage account as soon as possible, because right now is literally the best opportunity. 2020 has been a really good year to invest. Since the market's on a decline, what that does for us is you got to look at it as similar to a Black Friday sale. So whenever there's a product on sale at a store, what's your first thought that goes into your mind? You right away, you're like, okay, I gotta go to that store, I gotta purchase that product because it's on sale. The same thing is when it comes to individual stocks. When you see it's like a 20% down or 15% decrease, or there's a decline in the market overall and you want to purchase a certain amount of stocks, you can do that. You can even buy a mutual fund if you want, or an ETF. But overall, the best thing you should do is go with the Black Friday sale approach. You want to get into the market when it's on a decline. You don't want to get into the market when it's on an incline. Especially if it's a 2 to 3 day trend, you don't want to get into it, because then eventually, like that, what's going to happen is you're going to get into the market and then there's going to be kind of a decline because the trend is too high. Remember, not all things go up forever. So you got to realize that too, and you got to take that into consideration. So let me touch bases on the brokerage account and what you should open up. So overall, you should definitely look into Questrade, you should look into Wealthsimple, you should look into any of your banks. They all have brokerages. I'm based in Canada, so CIBC, TD, you got BMO, you got Scotiabank, you got RBC. All these banks offer brokerage accounts. But you gotta look at it like this: a brokerage account is very different from a checkings or a savings account. You gotta look at a brokerage account similar to a savings. You're not really touching the money in there, and it's very difficult to take the money out. So that they make it like the process more long term, because they don't want people to go in there in and out of the market every 2 seconds. So first off, when you go into the market, you really want to look at it as, okay, it's a savings account. I'm going to put my money in the market, and the first thing I'm going to worry about is figuring out what stock to purchase to begin with. And then you don't want to take the money out. You just want to leave it in there. You want to have it sitting there for a couple months, a year, 2 years. Because if you put the money in there and the first approach is like, okay, I need that money in a month, you're going to rush it. You're going to rush what stock you want to buy. You're going to go off hopes and prayers to try to get that stock to go up in a certain amount of time. That's not your plan. That shouldn't be a plan, because if you have a plan like that, your stock might go down, and what are you going to do? You're going to take the money out on a loss? It's not a good idea, because you should keep the money in there as long as you can. And you got to go with that approach of just be simple, keep everything simplicity. Don't really overcomplicate things. Look at the market more of an overall picture and an overall scheme. Eventually, the terminology and all the market stuff that people say online, and if you follow CNBC or stock market news or business news, all the terminology will eventually catch up with you. You just gotta go slow with it. just a legal disclaimer, I am no shape or form a financial advisor. If you want to get information on that, I'd highly advise you just find a financial advisor who's certified and they have all the papers. And like that, it might cost money up front, but at least you know you're going to get the correct information. But like overall, I am here just explaining how I learn stuff and how stuff works overall. So just follow along with the video, you'll get some tips out of it and hopefully it'll help you out. Now on the topic of how much money can I lose in the markets. Investing should be kept simple, not overcomplicated. You should look at investing as more of, you gotta have fun with it. You gotta be able to enjoy it. When you do it, it has to be something that you really get that sensation of like, okay, I just purchased that individual stock, it's helping me out, and I use it on a daily basis, so it kind of goes with the flow. When you have that personality and that mentality of, okay, I'm going to get into the market, I'm going to purchase that individual stock. For example, let's use Coca-Cola as a stock. I'm going to purchase that stock, and when I have it, I'm going to keep it because I want it long term, and if it goes down, I'm not going to worry about it. Because if you get emotionally attached to your money and you put that money into the market, what's going to happen is you're going to be looking at it every single day. It's going to start giving you you're going to start getting paranoid. You're going to start sleeping later because you're thinking about what happened during that day, and you're going to be looking at the market literally every 5 minutes. That's something you should not be doing. You shouldn't be looking at the market every 5 minutes. You got to look at the market as maybe once or twice a day, and you got to be calm. You can't really be like, okay, I got to make money out of it or else I'm going to lose my life out of it. I'm going to lose everything. It's not how it should be perceived as, because a lot of people overcomplicate what the market is. It isn't really like that. You gotta do your due diligence when it comes to the markets as well. So like, let's say I'm telling you a certain stock to buy. Don't go and buy it. Do your own due diligence. Look at the market. See what's going on. See how you feel about it. Feel comfortable? Buy it. If you don't feel comfortable, don't buy it. It's your own opinion at the end of the day. I'm just putting this information out to kind of give you some clarity and some better understanding to what the market really is. So the perfect example of a materialistic thing. My grandpa has a 20-year-old or 22-year-old Chevy white truck. So he's been having it for some time now. It's been having problems. He's not been driving it, but he leaves it parked outside on the road. So the thing about that is every other month he gets a ticket. And I've been telling him, like, get rid of the truck, you don't really need it. But the thing is, what old people, they're very emotionally attached to materialistic things. That's the same concept that's been passed down to our generation, which I'm 20 years old, so it's literally our generation and then generations to come. It's like a psychological thing that's been passed down. Like, you have to have attachments to things because you don't want to get rid of it. Stuff like that. So money is a big concept of that, because money, people get attached to it. They get it and they put it in their savings, or they waste it. And when they want to waste it, they waste it on wants instead of needs. Certain stocks pay dividends, which are something that I'm going to get into down the road. I'm going to explain what dividends are and what you should look at and what stocks you should buy that pay out dividends. So dividends are considered to be passive income. And when, let's say you go work at a 9-to-5 job, a Monday to Friday job, you work 40 hours a week. In order to receive that income, you have to be active. You have to be at the job site. If you're not there, and if you're not working at a restaurant or a construction site or cleaning cars, for example, you actually have to be there in order to earn that money. When it comes to dividend stocks, you don't have to be there. It's passive income. You can make that whenever you want. Same thing when it comes to e-commerce, or same thing when it comes to real estate. Those are all considered passive incomes. So overall, in the long term, what I'm trying to do with this channel is I'm trying to make you guys understand the difference between assets and liabilities, and assets that help you grow your passive income per month, like your cash flow. This is something I'm not really that comfortable with, talking straight and directly to a camera, but I'm trying to get used to it, so hopefully I can help you guys out in terms of investing and all that stuff. Because I do study this on a daily basis, and there's a lot of information I know that my friends and family members want to know as well, and they probably feel more comfortable learning it from me rather than learning it from someone else, because at least like this, they can message me on Instagram, they can message me on my phone number. I'll leave my Instagram down below, so if like any questions or anything related to the topic that I'm discussing here, you can just leave me a message or a DM on there, and then hope we can go from there. A lot of people get really confused in terms of whether or not they want to invest into a certain stock, or whether or not they want to wait it out and see if it goes up to a certain price. I just wanted to bring out some examples of certain companies that I like to invest into, that I'm currently invested into, and I've recommended these stocks to a lot of different people. And hopefully you guys can get a sense of relatability to this, because these companies you do use on a daily basis. Like the first company I'm about to tell you right now is, look at it right here, this is Apple. Apple has a stock, they pay out dividends. Apple is currently trading at $132 right now, American. So if you're Canadian, you'd have to probably pay around 170 or 168 or 150. I'm not too sure the average number, but you're gonna pay a little bit more because American dollars value more than Canadian dollars. But overall, Apple's an amazing stock. The whole world loves this company. This is an admired company. It's been around for years. Literally, it's one of the most valued companies in the world. It's a stock that you're always going to have here. Everybody's always going to be using it. iPhone is literally demolishing the whole other industry of cell phones, and now they're coming up with cars. That this is a company that is expanding into every single industry, and it's something that you can really get involved with. They actually registered to become a business May 8th, 1886. This is a company that's been around for over 100 years. It's going to make 200 years in about 50 years. So this company has been around for that long. It pays dividends also. And it's something that literally, like, what would compete against this? Anything that competes against Coca-Cola will eventually get bought out by Coca-Cola. You got Sprite, you got Smart Water, you got Vitamin Water. Anything that comes up against Coca-Cola, they buy out. So no matter what you do, even Warren Buffett owns this stock. He owns billions of dollars and in shares of this company. So no matter what you do, the stock will always do good. It will never go down. And if it does go down, you shouldn't look at it as a negative thing. It should be more of like a benefit towards you, because now you can buy it on a deal. Like I just finished saying earlier, the Black Friday sale. Anytime you see something go down, you got to picture it as a Black Friday sale, because like that, it gives you more incentive to want to purchase the company and invest into that stock. That's good. You guys definitely know McDonald's. It's in every single corner. Basically, every 10 blocks you'll find a McDonald's. Amazing prices, crappy food quality, for your body I mean, but the food is perceived value. It's very, very good for a decent price. And the 99% of the world will literally buy McDonald's literally every week. There's some people that eat McDonald's every single day. This is a company, this is a product that's been around for how long? As you can see right here, this book right here is by Ray Kroc, and he explains the life story of what happened to McDonald's, how it was created by the McDonald's brothers. Actually, they invented it. They had one restaurant, and then what ended up happening was Ray Kroc seen the opportunity, and he ended up using his real estate knowledge to use that and invest into McDonald's and expand that company, because the burgers and everything in there was amazing. So this book basically explains it. If you guys want to get this book, it's like $7 on Amazon. So right now McDonald's is currently trading at 215 American dollars, which is quite expensive in terms of a stock to buy. It's your first stock, but it's definitely a stock to look into, because they're never going to go bankrupt. They're never going to get out of the game. They've been around here for how long, and they're going to stay here. They're going to continue to be amazing just because of the product they sell. They don't sell crap. They sell decent stuff. They sell stuff that literally for people who enjoy eating every single day. So it's something that you should really look into investing, and it also pays dividends. So overall, we talked about when you should get into the market, what type of companies you should look into investing in the beginning stages, because they're safe investments, they're low risk. And we also talked about getting rid of your emotional attachment towards money, because it's materialistic. I just wanted to finish the video off with some percentages and what amount you should invest into when you're starting off in the beginning. Overall, I'd say start with $100. Maybe if you want to start with more, if you're more confident, put in $1,000 into the market, because something like that, you get more incentive when you add more money into the market. You start getting nervous as well, because once you have a lot of money into the market, it's going to start getting you paranoid. You're going to start looking into it. So if you're less comfortable investing $1,000, put $100. But overall, look at it like this. Think of this analogy. This is something that I just thought about literally right now. So imagine if you had an ice bath and you had to jump in, right? Someone who's more experienced, someone who's been doing it on a daily basis or a weekly basis, they get into there pretty confident. They're pretty confident when they get into that water. They're comfortable. They're not overreactive. They're not pure nervous as soon as they're about to get into it. They're actually pretty confident when they get into that. So they go with their feet first, obviously, and then they get into the water in less than like literally 3 minutes. But somebody who's never done it before, what do you expect them to do? They're gonna go into there very slowly. They're gonna dip their toes first. They're gonna check if the water is decent. They're gonna see if they're gonna freeze and lose a foot or something. So overall, when it comes to that type of analogy. That's the same approach you want to use when you get into the market. Don't jump into their head first. Don't buy a stock that's $1,000 and it's one stock. Try to diversify a bit. Buy 3-4 companies. And when you have 3-4 companies, you're more lenient. You're more like relaxed, because you also want to try to get into 2 different industries, at least minimum 2 different industries. So that, for what I mean by that is, let's say you want to get into McDonald's and Coca-Cola. That's kind of the same industry. They're more restaurant, food related. But let's say you want to get into Apple. That's more of a technology industry. So technology is very safe. Restaurant is very safe. There's some companies that are not very safe to get, but the companies I talked about, they're very safe. Just invest into those when starting out. Hopefully this little video I made with a bit of insight helped you guys out, just even a tiny bit. And if you guys want more videos like this, just let me know. Leave a comment down below if I missed something out, or if you have a question related to the topic I'm talking about. But I'm gonna get into another video after this. I'm gonna make a video related to Questrade, how to open up an account, what the buying stuff means, like market buy, limit order, stop loss, limit order. There's a bunch of things you have to understand. Also the conversion rates, whether or not you should go Wealthsimple, Questrade, or the bank offers a brokerage account overall, or you want to go with the slow approach, you want to go with a mutual fund. That's basically what this video is about. Thank you guys for watching. See you next time.